What if you could build a system that generates income whether a stock goes up, goes down, or goes nowhere? Not a magic formula, not a black box, just a repeatable cycle of two strategies you already know working together. It's called the wheel strategy. And for traders who want consistent cash flow without staring at screens all day, it might be the closest thing to a business model the stock market offers. Let's put it all together. The wheel is a three-phase income strategy that combines cash-secured puts and covered calls into a continuous loop. Phase 1. You sell a cash-secured put on a stock you want to own. You collect premium. If the stock stays above your strike, you keep the premium and repeat. If you get assigned, you move to Phase 2. Phase 2, you now own the shares. You sell a covered call against them. You collect more premium. If the stock stays below your call strike, the call expires, you keep the premium and you sell another call. If the stock rises above your strike, your shares get called away. You move to Phase 3. Phase 3, you're back to cash. You start again with a cash-secured put. That's the wheel. Sell puts, get assigned. Sell calls, get called away. Repeat. At every stage, you're collecting income. The wheel works because it aligns with how the options market naturally behaves. Most options, somewhere around 60 to 80% depending on the study and conditions, expire worthless. As a seller, that statistic works in your favor. You're collecting premium that, more often than not, you get to keep. The strategy also forces discipline. You choose your entry price before you sell the put. You choose your exit price before you sell the call. There's no emotional buying or panic selling. Every move is predefined, and it generates income in all market conditions. In a rising market, your puts expire worthless, pure profit. In a flat market, you keep cycling through puts and calls, stacking premium. In a falling market, you get assigned shares at a discount and immediately start selling calls to reduce your cost basis further. The only scenario that hurts is a sustained, dramatic decline in the underlying stock, which is why stock selection is everything. This is the foundation. Get this wrong, and the wheel breaks down. You want stocks that have strong fundamentals, companies with solid balance sheets, consistent earnings, and a competitive moat. Think of names you'd be genuinely comfortable holding through a 20% drawdown. You want liquidity in both the stock and its options. Tight bid-ask spreads mean you're not bleeding money on every entry and exit. Stocks with weekly or high-frequency options give you more flexibility on timing. You want moderate volatility. Too low, and the premiums aren't worth the capital commitment. Too high, and you're taking on unnecessary risk of large drops. The sweet spot is stocks with an implied volatility rank between 20 and 50, though this depends on your risk tolerance. Good wheel candidates are often large-cap blue-chip names or highly liquid ETFs. Think about the stocks that, if they dropped 15%, you'd actually want to buy more of. Not panic out of and avoid earnings season for new positions. The IV spike around earnings might look tempting, but the potential for a 10% gap against you isn't worth it within the wheel framework. Let me walk you through a full cycle. You pick a stock trading at $100. You'd be happy to own it at $95. Week 1, you sell a cash-secured put with a $95 strike, 30 days to expiration. You collect $2 per share. That's $200 per contract. You set aside $9,500 in cash. 4 weeks later, the stock is at $98. Your put expires worthless. You made $200, which is a 2.1% return on that $9,500 in 30 days. You sell another put. This time, over the next 30 days, the stock drops to 93. You're assigned 100 shares at 95. Your effective cost basis is $93, the $95 strike minus the $2 you collected on this put. And if you count the $200 from the first put, your real cost basis is even lower. Phase 2 begins. You sell a covered call with a $98 strike 30 days out. You collect $1.50 per share, 115. Now your cost basis drops to $91.50. Over the next month, the stock recovers to 99. Your shares get called away at $98. You collect $98 per share on stock that cost you effectively $91.50. That's a $6.50 per share gain, plus all the premium you collected along the way. Phase 3, you're back to cash, ready to sell another put. The wheel keeps turning. One of the most important disciplines in the wheel is tracking your true cost basis. Every premium you collect reduces your effective entry price. Every call premium you collect while holding shares lowers it further. Over multiple cycles on the same stock, your cost basis can drop significantly, giving you a cushion that makes it very hard to lose money over the long term. Keep a simple journal. For each cycle, note the put premium collected, the assignment price, every call premium collected, and the final exit price. Add it up, that's your true return. This is where the wheel reveals its real power. It's not about hitting home runs. It's about consistent singles and doubles that compound over time. Let's be honest about when the wheel gets uncomfortable. If the stock drops significantly after assignment, say from $95 to $75, you're holding shares at a loss. Selling covered calls at the $95 or $98 strike might only generate pennies in premium because those strikes are so far out of the money. You have options. You can sell calls at a lower strike, say $85, for more premium, accepting that if the stock rebounds fast, you'll sell at a lower price than you bought. Or you can sell calls further out in time, 60 or 90 days, to collect more premium at a higher strike. Some traders in this situation simply hold and sell small premium calls repeatedly, slowly chipping away at their cost basis. Others add to their position at the lower price if their thesis on the company is still intact. The key is not to panic, not to sell the shares at the bottom, and to remember that this scenario is exactly why you chose a company you believe in for the long term. A few things that can enhance the wheel. Consider using weekly options for the covered call phase. Shorter expirations give you more flexibility and more decision points. You can adjust strikes more frequently based on how the stock is moving. Pay attention to ex-dividend dates. If you're assigned shares on a stock that pays a dividend, that's bonus income on top of the premium. Track your annualized return on capital. A 2% return every 30 days annualizes to over 24%. Even a conservative 1% monthly translates to over 12% annually. This is real, compounding income. And consider running the wheel on 3 to 5 stocks simultaneously. Diversification across sectors and expirations smooths out your income and reduces the impact of any single position going against you. The wheel strategy is a continuous income loop. Sell puts to get paid to wait, sell calls to get paid to hold, and repeat. Choose fundamentally strong, liquid stocks you'd own at any phase. Track your cost basis meticulously. Manage the tough scenarios with patience, not panic. It's not flashy, but it's the kind of strategy that, over months and years, can produce meaningful, consistent income. This is what it looks like to trade like a business. Subscribe for more. This series is building a complete options trading education. Calm, methodical, one strategy at a time. See you in the next one.